Hello. It's,
Good afternoon, Professor.
hi,
Hello.
how are you? Hi, good afternoon. It's almost like, almost like, echo, right? When you shout uh, into the cave, then the echo comes back in in 5 seconds. There's delay, right? Like the echo. So, uh, let's see. We have on. Let me just quickly check the our forum today, and we have like 15 people who signed into the forum, and we have how many people here? 14. So one is missing. Okay, so Safia, I believe, just joined. So it must be 16. No, no. Three columns, 5 rows, so 15. I don't know why. So one person is still missing. All righty. So everybody, I'm sure everybody did the concept check, right? ROI concept check. It is still visible. I mean, you can't do it anymore. Uh, the deadline is, the deadline, it's past due, so you can't do it anymore. But for your review, it's still visible. You can see what you got wrong, what you got right, and there's some feedback. I don't know. Uh, but if you have any, uh, I can. If you have any questions, I can answer that. But uh, obviously, it would be okay. So 16, 14. How come? How come 14? Oh yeah, 3 times 4, 12, and 3 times, so 13 out of 16. Okay, you see what I'm talking about? Maybe you're not. See, application screen, entire screen. Okay, so you can see, you see down here, it says 16 participants. So one of those 16 is me. So if I take out me, excluding myself, there are 15. But yeah, Yanting, you raised your hand, right? You have a question, Yanting?
Not really. I missed the mistake. Sorry.
Oh, no problem, no problem. So yeah, I think I have 16 now because now this is that's 17 including myself, and that's the number of people. 16 is the number of people. Let's see. You see, there are 17, including myself, so everyone is present. Okay. Now, I believe you may have questions but before, uh, about the ROI, the test quiz, or it's actually it's a self-test. Okay, what that means is it's not gonna factor into your semester grade. As I said before, your semester grade comes from first and the second quiz. This is not the one. This is not the one. And then 20% weight of each quiz is 20%. And the midterm and final, weight of midterm and final is 25% each. So total weight is 90% coming from quiz 1, quiz 2, midterm, and final. And the 10% comes from your attendance and participation. Okay? And there are 2 self-tests. This is the first one. The next self-test will be named ROI practice. It will be just, multiple choice questions. But what are these self-tests, and how do they, if they don't factor into grade, what's that for? Literally, it's the self-test. But then, suppose you didn't do well. I mean, suppose you messed up one of the you messed up quiz 2, or you messed up midterm. One of these 4 exams you messed up. Well, so because you messed up one of these exams, and you are at risk of falling below B minus, and that letter grade can only be assigned, it can be only calculated at the end of the semester after I collect all the data. Before I collect all the data, there's no way letter grade can be assigned, because I'm still, missing 20. If you haven't done final yet, I'm still missing 25% of the data. And if I miss, if you're missing 25% of the data, there's no way the semester grade can be calculated with 25% missing. Okay, so at the end of the semester, when I have 100% of the data, and based on that, if you're at risk of falling below B minus, and if you did well in the, however you did, well or not, the average of these practice tests will kick in, right? The average of these practice tests will kick in to boost the lowest exam score. So then that will have an effect of pulling up. So basically, if you're already good, if you're already A minus, B plus, and at least, because B minus is the decent grade, B minus is the cutoff line for decent grade. And when you transfer to a 4-year school, they only take B minus and above. So B minus is the decent grade, and if you're at risk of falling below B minus, then the average of these practice tests will kick in, and it will bump up the lowest exam score even marginally. And by marginally, if it is bumping up, if it bumps up the lowest score, then, and if you are marginally below B minus, if you're marginally below B minus, then that will, so you're C plus, but you are just marginally falling below B minus. That will push up, right? That will bump it up to B minus. And everything below it will also, like you got C, then marginally below C plus, you're C, but marginally below C plus. It will bump it up to C plus, and so on, consecutively. Subsequently, so on. So that's the point of these practice tests. Okay. Also, it's on your own self-evaluation. Basically, evaluating how well you understand and how well you have digested the material. Okay. So, all right. Now, I'm not going to go over the ROI concept check today. We have things to cover. Maybe, we will, after finishing, we are already, 1 day behind already. Why? Because let me show you. today's material, right? Today's video assignments. Already today you have to be into topic 2. You see? July. Okay, this is gonna be. So you should be already into. You should be doing this reading. I mean, this is video watching, but as I said, this is the assigned reading assignment. It's like video reading assignment, and you should have done already. So let me quickly check if this is the. Okay. I was already in discussion board. What am I doing? Today's lecture. Yeah, financial statements intro, videos 1 through 5, because each video is 30 minutes long, so that's like 2 hour 30 minutes worth of videos. So you should be watching these videos already, but so we cannot dwell on the past topics for too long, but still we'll have to we need to okay, I'm gonna have to let me open okay, and ROI house value, and then ROI house value. Oh no, not this one. What? Where is it? Okay, this is what we used last time. And then so I gotta finish up this. Okay. So we may be able to come back to review the concept check tomorrow, but for now we gotta wrap this up so we can move on to topic 2. Now, so earlier, right? We talked about what interest rate, how interest rate is related to return on investment. Remember that? I said interest rate is the return on your money, right? Because when you put your money in the bank, you are passively lending to the bank. So that's why you are getting interest from the bank, and you are passively investing. You don't invest directly to the stocks, or you don't directly lend to any borrower, but bank does that. Bank intermediates that. So that's why bank pays fixed interest to you, which is very meager level, meager amount. But you don't take any risk, right? It's almost risk-free because it's a but then think about it, the trade-off. I mean, you're not taking any risk, so it's safe. But then immaterial, that derogatory, almost derogatorily immaterial interest rate is the trade-off for that safety, right? But anyway, that's the bottom line. I mean, there is no safer return on your money. There's no safer return on investment than the bank interest rate. Now, but then, what is the bottom line of? I told you, when the borrowing rate, in other words, when you lend to the bank, when you put your money in the bank, it's borrowing from the bank's perspective. From the industry perspective, the interest rate they pay is borrowing rate. But then think about it. That rate is almost like 0.1%. Regardless of who you are, regardless of how good your credit score is, regardless of how bad your credit score is, it's just 0.1%. But remember, their lending rate, the bank's lending rate, varies depending on your credit score. And if you have excellent credit score, you are a low risk to the bank. And the risk in this context means default risk. Remember that? Anybody? The default, so as the default risk is low, you are a low risk to the bank, so they don't have to charge high interest rate on you. They don't have to charge high. Why? Because think about it. You have excellent credit score, and you have your credit score is like 840, 30, 40. Excellent credit score. Your credit score cannot be better than that, right? Practically, 850 is the highest possible credit score. Now, so think about it. You want to borrow money, and they charge you like 5% interest. What can you do? You can always. Banking is a very competitive industry, right? Banking is a competitive industry. That's not the only bank, right? You can choose, right? You can shop around. There are plenty of banks that are trying to get you, right? Because you are a high quality borrower, right? There are plenty of banks that will lend to you at a lower rate. So they don't want to lose you, right? The bank, they know you can shop around. So this is pretty much the buyer's market. In other words, you are the buyer, right? You're the shopper. You're shopping around. You're shopping for a good interest rate. You're shopping around. And since you are a high quality borrower, you are in a position to dictate, or you're in a position to command this market, right? So they cannot charge outrageous rate to you if you have high credit score, excellent credit score, and if you're a high quality borrower. On the other hand, if you have bad credit score, they will all, like vultures, they will all descend upon you. If you're in the market for borrowing, they will all try to competitively charge. Of course, even if you among them, you can shop for the best rate for you. So then the question, we all know. So there is a difference between lending rate and borrowing rate. There's a difference between lending rate and borrowing rate. Anybody remember what that is called? Difference between lending rate and borrowing rate? Anybody?
Did the ROI, something like that? I don't remember.
No, ROI is simply return on investment. ROI stands for simply return on investment. What's the difference between the lending rate and borrowing rate called? What is the name for that? Are you following? Are you guys following what I'm saying? It seems like no, you're not following. Look, you understand what I'm talking about? No matter how good your credit score or how bad your credit score, when you put your money in the bank, you just, you earn only 0.1%, right? There is no, when you are borrowing, there's no difference. I mean, when you are lending to the bank, there's no difference, right? You earn the same interest, whether you're, regardless of your credit score. But when you are borrowing, then depending on the credit score, your borrowing rates are different, right? If you have excellent credit score, your borrowing rate, your interest rate will be low. If you have bad credit score, mediocre credit score, your interest rate will be high. So even if you have, let's say, if you have excellent credit score, when you borrow, still you may be paying about 3%, right? When you borrow from the bank. But when you put your money in the bank, it's only 0.1%, regardless of who you are, regardless of what your credit score is. So what does that mean? Suppose you put $1 million in the bank, you just get 0.1% on it. But when you borrow $1 million from the bank, right, that 1 million must have come from somebody else, right? That 1 million is could have come from your own deposit, or it could have come from someone else's deposit. But when you put your money in the bank, you just get 0.1%. 1% of 1 million is 10,000, right? 0.1% is 1,000. So annually, you just get, regardless, 0.1%. But when you borrow, so think about it. You put your 1 million in the bank, you get 0.1. But when you borrow from the bank, that's your own 1 million that, you can just withdraw that 1 million. But suppose you are, borrowing 1 million. If you have good credit score, you still have to pay, you pay 3%. If you have a bad credit score, you may pay 10% or 11%. Right? Do you understand? But what is that difference called? I mean, the difference, if you have a good credit score, the difference between your borrowing rate and lending rate is 2.9%. What is that 2.9% called? We talked about this in the previous classes, and we had only 3 days of class last week, and you completely forgot. Huh?
Yep.
So no, you didn't. So what is that difference called?
The APR.
No, APR is simply annual percentage rate. I don't know why my voice is echoing. And it's even right in front of your, it's right in your face. And how come you don't even, how come? So what is the difference between the lending rate and borrowing rate?
Spread.
Someone
Spread.
said? Someone? Yeah, who is this?
Yeah, who is this?
Who is this?
Sophia.
Who is this?
Who?
Sophia.
Who?
Sophia.
Sophia, okay.
Sophia, okay.
So, Sophia,
Sophia,
you got 0.25 for that
0.25
answer.
for that.
Oh, I don't know why my voice is echoing. It's not from my own computer. It's from somebody's computer. I don't know. And it's even echoing very loudly. That's basically the level of volume that you hear me. But the level of volume I hear of your voice is very faint, except for some people. I want you to speak. I want you to speak at that level of volume. Okay? All right, good. That's called spread. It's specifically it's called interest rate spread, right? So our next question is then, so who determines this interest rate? Who determines this interest rate? Who sets this interest rate? Right? Who sets this interest rate?
Who says interest rate?
Of course.
Of course.
Okay, it's someone's.
I think someone's mic.
Someone's microphone is unmuted, and if it is, it's my voice, and it's very loud. So if you're not speaking, please mute your microphone. Okay. So, huh? Yeah, Federal Reserve. Okay, yeah, good answer. Federal Reserve. And who is this?
Abul.
Abul. Okay. Abul. So I'm giving you 0.25 for this. So in large, it's called central bank, right? Central bank of any country set, and in the U.S. This in every country this is called benchmark rate. In every country, the rate set by the central bank is called benchmark rate. Benchmark. But in the U.S. specifically, this benchmark rate in the U.S. is called what? What is this benchmark rate called in the U.S.? Anybody?
Inflation.
No,
Inflation is the interest rate.
Inflation is not
Inflation
interest
is not
rate.
interest rate.
I don't know.
I don't know
why only my voice is
echoing
loud.
loud.
Please mute your microphone, please.
Is it the minimum interest rate? Is that what a benchmark is?
Yes. That's the baseline interest rate or benchmark rate. But in the U.S. specifically, what is it called? In the U.S. The generic term is you guys also hear my voice echoing, right? Do you hear my voice echo?
My voice echo?
No.
No, you don't?
No, you don't?
I hear my voice echo. And it's not coming from my computer. It must be coming from somebody's computer. And it's very loud. So I get interrupted, every once in a while. Because when voices are all overlapping, you can't even, so anyway, as I said, the generic term for that rate set by the central banks is called benchmark rate, but then specifically in the U.S. is called excuse me. Anybody? Excuse me.
A federal rate?
No, that's not the
No,
correct
that's not the
term.
correct term.
Fed funds
Correct
rate?
term
Correct
is,
term
it's
is,
also
it's
right in your
also right
face.
in your face.
Fed funds rate?
Yeah,
The
Fed
FRB?
funds
Fed
rate.
funds rate.
Fed funds rate.
Fed funds rate.
Okay. It's my
My
voice is
voice
echoing
is echoing.
twice. Actually, Fed funds rate is also an abbreviation because the correct name, full name is Federal Funds Market Rate. Federal Funds Market Rate. Okay, so it looks like, it sounds like as if the federal funds market rate is set by the Federal Reserve. Actually, um, it is set by the Federal Reserve, but it's not the market rate. It's not the spot market rate. In other words, what is then? It's the target rate. It's the target rate that is set by the Federal Reserve, not the actual spot rate in the market. So, what is federal funds market and what is the spot rate? What is the market spot rate? So, first of all, federal funds market is it's not Federal Reserve. It's the online market for commercial banks to lend money, to borrow and lend money to and from each other. You understand? It's a short-term overnight market to borrow funds and lend funds to and from each other. So it's something like this. How many commercial banks are there in the US? I mean, commercial banks, there are two types of banks. First of all, commercial bank and investment bank. Now, investment bank is, uh, the banks that do, the banks that launch IPO, right, for sale of new stocks, for company that is going public. Investment banks generally underwrite IPOs, and then they earn fees from helping to launch, initial public offering, and they also do management consulting. So basically, J.P. Morgan and Merrill Lynch. These are, very well-known, two of the very well-known investment banks. There are other investment banks as well, but it's just well-known names. So investment banks are not doing business in your neighborhood. The Chase, Citi, Bank of America, these are commercial banks. Wells Fargo, Capital One. These are commercial banks. They are also called retail banks, right? Retail banks. And there is something like a Citizens Bank or retail banks are where the customers like you go to deposit money or to borrow money. To borrow money for what? Either for business. I mean, there are, as I said before, in your life, you probably don't have any major borrowing, but in the future, you will definitely need to borrow money. Why? First of all, you don't have any. If you don't have any student loan, that's good. That's fine. But there will be a time when you buy a car. Basically, you finance. You don't, which means you just make the down payment and you borrow the rest from a lender or a bank. And you don't, so in that case, you think, oh, I must then contact the bank first and, secure the loan and then buy the car. No, you just go to the car dealership, and at the car dealership, they mediate. I mean, they find the lender for you because car dealership has to make a sale. They have to sell the car. They usually, car makers. I mean, all the car makers, automakers like GM, General Motors, Chrysler, Fiat, Chrysler, Ford. They all have their own bank, their own, financing arm. So they all, if you buy a Hyundai car, they use, Hyundai financing, which is a bank, their financing arm, and they, basically, if you're buying a $40,000 car, you make, like $3,000 down payment or $5,000 down payment, and then the balance, 35,000 will be financed by that bank, right? So when you buy a car, and if you buy a house, mortgage, right? So there will be a couple of times in your life, and if you start your own business, if you start up your own business, where does the startup capital come from? You'll have to borrow from the bank. I mean, it's a good thing you don't have any major borrowing just at this point in your life. But then, so basically when you borrow, you go to the commercial bank, right? Retail bank, which is, like Chase, Citi, Bank of America. And remember I told you investment banking and commercial banking are separate. During in the early 2000s, they I believe it was Glass-Steagall Act. Glass-Steagall Act was, basically introduced in the 1930s, and it after the stock market crash of 1929, they they legislated Glass-Steagall Act, which separated commercial banking, investment banking from commercial banking. And then by the early 2000s, then the Glass-Steagall Act was repealed. So the line between commercial banking and investment banking was blurred. And then after that, 2008 financial crisis. All because, if the banking is not regulated, banking industry is not regulated, then they go unchecked and unbridled and unchecked. So they go too. There's too much, moral hazard and risk taking. So that entails financial crisis. So they now the separation between investment banking and commercial banking is back after 2009. Okay, so then, as I said, commercial banks. So question is, what is the Fed funds market? Federal funds market is where an overnight market for funds to borrow and lend from and lend to each other between the commercial banks. And it's possible because when think about it, you think the bank is closing at 5 p.m. Yes, the bank branches close at 5 p.m. But at the main headquarter, of all these, banks, commercial banks, is 24 hours. Why? What do you think is the main business of banking? I mean, how do you think, what's the business model? How do you think, how do they make money? How do you think they make money?
From interest?
Who said
From interest?
from interest? In what interest? I mean, interest they pay or interest they collect?
Yes.
What do you mean? Yeah.
Yeah, so interest from when they lend money out to like
Yeah,
businesses or
yeah.
individuals.
Exactly. It's from banks make money by lending money because a bank's income is from interest from lending. I mean, it's not only lending. If you think about it, banks also use their funds, to invest in the stock market, right? So a bank manages a well-diversified portfolio. I mean, if Chase alone has, if Chase has $100 billion of deposit, right? Deposit that came from all depositors, right? All customers. Some of it is loaned out. It is loaned out mainly to corporations, right? The loan is mainly to corporations, businesses. And then some of it is, loaned out to real estate. I mean, individuals or businesses buying real estate, right? They have to borrow money from the bank. So some of it is, in real estate, and some of it is in stock market, right? So, but let's just simplify that. They mainly, because the banks make money by lending money and investing money, not by taking the deposits. Because if they take deposit, they have to pay out interest. But if they lend out, that's how they earn interest. So, and think about it. After 5 p.m., branches close, but at 5 p.m. branches close, but the headquarter is working. Why? Because they have to invest money and they have to use that money, put it somewhere in some investment instrument, and the worldwide. Think about it. New York Stock Exchange closes at 4 p.m. At 4 p.m. stock market closes. But even after 4 p.m., there is aftermarket, some, residual transaction, aftermarket transaction, and some residual transactions. It's not only New York Stock Exchange. Think about it. Even in U.S., there are 3 time zones. 3 time zones, right? I don't know if I'm not. When New York Stock Exchange closes, I think Chicago and Houston or LA, San Francisco, they all close. I mean, it's only, I'm not sure if they are still open until like 4 p.m. their time, but the stock exchange is mainly, in New York. So if the stock exchange, American Stock Exchange, New York Stock Exchange, there's Chicago Commodity Exchange in Chicago. Chicago Commodity Exchange may run until 4 p.m. Central Time. Not Central Time, yeah, Central. That's Central Time. But at 4 p.m. East Coast time, stock market closes. West Coast, they close as well. That would be like 1 p.m. there. They when they open at 9 p.m. that's 9 a.m. that's 6 a.m. in the West Coast. But they have to go by New York Stock, New York Stock Exchange, and market. The stocks are listed in New York Stock Exchange or American Stock Exchange or NASDAQ. They are all in New York, based in New York. These stock exchanges are based in New York. So stocks are listed there. Bonds are listed there. So there is no, unless there's a separate stock exchange in San Francisco or LA, and I don't think, I've never heard of any a separate stock exchange there. So the market closes at 4 p.m. It is 1 p.m. there in the West Coast. But look, when it is 4 p.m. in New York, and what time do you think it is in Tokyo or Seoul, East Asia, or Sydney, Australia? Sydney, Australia is actually the first city where the sun rises, right? The day breaks the first in Sydney, Australia, right? And if I remember correctly, Tokyo and Seoul and Tokyo are like 14 hours ahead of New York. 14 hours ahead. Sydney, Australia is 15 hours ahead of New York, right? London, Paris, Western Europe, all Western Europe is even Eastern Europe. If I remember correctly, Czech Republic, Hungary, Central Europe, they all go by Greenwich time. So Paris, Berlin, Frankfurt, London, they are like 6 hours ahead of New York, right? So when New York, it's 4 p.m. New York, it's 14 hours ahead. So it's 6 a.m. in Seoul and Tokyo. And it is 7 a.m. in Sydney, Australia. So their market will open in a few hours, right? Their market will open in at 9 a.m. So Sydney, Australia, if 2 hours, in 2 hours, they will open, their stock market will open. So think about it. It's round the clock. Stock markets are round the clock, right? So these headquarters, after 5 p.m., they are still watching for Sydney market to open, or Seoul Stock Exchange to open, Tokyo Exchange to open, and when they identify a good investment instrument, they will put money there. But think about it. So Chase has, let's say, $10 billion currently that they can put into these. Let's say they found this good stock in Sydney market. They want to put it in there, but let's say they are lacking. They are not really, they have 10 billion available to invest, but let's say for this particular stock, they have only about 1 billion to invest in. But this is they want to put like 11 billion. They don't have that 1 billion. They only have 10 billion. or 10 million. They don't have that 1 million. So what do? In the overnight Fed funds market, they can borrow. They can borrow 1 million from another bank, right? And the Fed funds rate is currently just like about 0.25. So they borrow overnight, and 0.2. And I told you, it's all annual. All the rates are basically annual. So it's 0.25% annual. So just borrowing it overnight, it will be a fraction of that. It will be like 0.25% times 1/365. Makes sense? That's the interest on $1 million for overnight. So then the next day when the bank opens, then there will be more funds coming in, so they can easily pay back with 0.25% interest, right? So this is the reason for federal funds market, right? If they have a shortage, if they have a short fall in the funds, then they can borrow overnight. So why is this? Why is this a benchmark rate in the U.S.? As I said, every country, the central bank sets the benchmark rate, and in the U.S. it's called the federal funds rate. In UK, it's called LIBOR rate in UK, right? And does anyone know what LIBOR stands for? LIBOR rate, LIBOR, LIBOR rate. Does anyone? LIBOR.
Something
No one?
offered rate.
Yeah. Offer. No, that word is included. Offer. That word is part of that. Of course, LIBOR, right? That O stands. Obviously, that O stands for offer, right? But what are the other initials stand for? What do the other
London
letters?
Insurance Bank.
London Insurance Bank?
Interbank.
I'll say that again.
London
Who
Interbank.
is it? Yeah, London. Okay, so LIBOR, LI. Okay, London Interbank, LIB, is taken care of, right? It's explained. Then O stands for offer, right? O stands for offer. Then what does that final R stands for?
Rate.
Of course, rate. It's LIBOR, LIBOR. So London Interbank Offer Rate. So think about it. Isn't that the same idea? The Fed funds market is for commercial banks in the U.S. to borrow from and lend to each other, right? For LIBOR means London Interbank Offer Rate. So between the banks in London, it's not only London. It's just named that because in the old days it was mainly between the banks in London, but now it's basically every UK bank, right, in UK. So between the banks in London, they offer this rate, right, for lending and borrowing. So it's the same idea, right? But then, isn't this? So this is basically, private. Fed funds market is basically the market for private banks, not central bank, right? Is any commercial bank can be lending and borrowing in the Fed funds market, but why then Federal Reserve sets this rate? It's like in London, in LIBOR rate, it's like that rate, interbank offer rate, is set by the Bank of England. So does the Federal Reserve set this rate? And as I said before, Federal Reserve only sets the target rate. Target. So this is the target, and actual rate in the market can be different from the target rate, but Federal Reserve will participate in this market, and they will try to bring the actual rate close to the target rate. Okay, so. In other words, target can be set by the Federal Reserve, but the actual rate is determined by market transactions, by demand and supply of between the commercial banks. Think about it. Even if Federal Reserve sets the target rate at 0.25, if there is no demand for borrowing between the commercial banks, then the rate will be zero. It cannot be 0.25. Think about it. What drives the price?
Demand.
Demand, yes. Not only demand, but demand and supply, right? But when supply is fixed, when supply is constant, and who was this?
Sophia.
Safia again. Okay, so you answered London interbank offer rate, and you answered this. So that is 0.5. Okay, that is 0.5. So yeah, basically, if the supply is constant, what drives up the price is mainly the demand. If there's a strong demand, the price will have to go up. But then you might wonder, what does price have to do with this? We are talking about the interest rate, right? What does price have to do with this? Now, have you ever, I don't know if you ever thought about it this way, but isn't interest rate some kind of price? Isn't interest rate a kind of price too? Don't you think?
Yes. It's almost like an additional charge onto the original price that you're going to pay back.
I'll say that again. So it's a price in what sense?
So in the sense that, like, if you, for example, if you're being charged interest on like money that you're borrowing, you're going to be paying, it's the additional price that you're going to pay back on top of the original amount that you borrowed.
Yes, but to put it, yeah, of course, it's the additional amount on top of the borrowed amount, right? But why is that additional amount a price? Well, it's obvious. That's the price for borrowing money, isn't it right?
Yes.
Yes, right. Yes.
Yes, interest rate is the price for borrowing money, right? So interest rate is, in that sense,
Yes.
Interest rate is also interest rate is also governed by the same principle. When there is a high demand, strong demand for borrowing, interest rate will go up. When there is no demand for borrowing, interest rate will be zero, right? So the actual Fed funds rate is determined by demand and supply for funds in the Fed funds market, right? So it's not like even if the Federal Reserve sets the target at 0.25 or 0.5%, if there is no demand, it's not going to hold. Okay, the actual rate cannot be 0.25 or 0.5. And even if Federal Reserve sets the target rate at 0.25, if there's too much demand, strong demand, then also that target rate cannot be upheld. It will have to be, the actual rate will be greater than 0.25. So what the Federal Reserve does is, so actual rate is always between, even if Federal Reserve sets the target is like, between 0.25 and 0.5 or 0 to 0.25. Why? Because it's a range. It's not a point. You understand? The actual interest rate is not a point. It's a range. The actual rate will vary within the range. Okay, everyone understands that? So the target rate is also set as the range. Okay, so then how does Federal Reserve how does the Federal Reserve affect the Fed funds rate? Okay, so I have an up. So everyone understands that in 2000. Come on, why is this thing there? Let's take a look at this graph. 2006, 2007, 2008. What happened in 2008? So July 2008 and January 2009. January 2009 is the same thing, like, beginning of January 2009 is the same thing as end of 2008, right? We all know what happened throughout 2008. There was a financial crisis. So because of the recession induced by the financial crisis, Federal Reserve dropped the interest rate to, think about it, at the beginning of 2008, it was where? It was at 5%, 5.25. It was at 5.25. And just over 1 year period, it dropped to 0.25. This is called easy money policy. To stimulate the economy, you have to pump money into the economy. So how do you pump money into the economy? You make it easier to borrow. Right? Makes sense? Now,
Yeah.
high interest rate, when the interest rate is high, it's a barrier, it's a deterrent, right? It's too much burden to borrow. I mean, think about it. If the interest rate is 10%, is it easy to borrow? I mean, if the interest rate is 20%, can you borrow? I mean, you want to borrow $1 million. Interest rate is, 10% a year. Obviously, it's difficult to borrow, isn't it right?
Yes.
Yeah,
Yes,
it's a
that's lot.
deterrent.
Everything that.
Right. It's a lot. It's too much burden. So if borrowing is suppressed, then the economy cannot recover. Because think about it. What stimulates the economy is investing in your investing in business. For example, if you're a business owner, if you're a business owner, and if the demand for your products are rising, right? If the demand for your products are rising by 10% a year, I mean, obviously that means your market is growing, your market share is growing, and your market is expanding, and you must meet the demand. And with the current production capacity, you cannot meet the 10% growth a year, right? In just 2 years, the growth will be in just 2 years, the growth will be 1.1 raised to 2, so we'll be like uh, 21.2% in just 2 years. So with if your current production capacity with your current is maxed out, you cannot meet this increasing demand. So what do you have to do? You have to invest in your business so that your production capacity would expand. And if your production capacity expands, then you can meet the increasing demand. Say that again.
I say yeah, because then you'll be making products much faster.
Yeah. Your output increases, and that means your revenue will increase. With increased revenue, your profit will increase as well. Of course, the profit margin may or may not increase, but a profit by sheer number, it will increase. So, if look, in 2006, between 2005 and 2006, why did they raise the interest rate from actually between 2005 and 2006 or 2004? I don't have the rest of the data, but if I remember correctly, over just 1 year, between 2005 and 2006, they raised the interest rate within just 1 year by 4.25%, 4.25. That means the Fed funds rate at the beginning of 2005 or at the end of 2004 was like only about 1%. But then just over 1 year period, they raised the interest rate drastically like that by 4.25. And why was that? Because there was a lot of housing market bubble. There was a lot of housing market bubble by 2004, 2005, and then the newly appointed Fed chair at the time, Ben Bernanke. After Ben Bernanke, it was Janet Yellen. After Janet Yellen, it is now Jerome Powell, right? I think Ben Bernanke served 2 terms. He served 2 terms for 8 years. Janet Yellen served only 1 term. Jerome Powell, I think this is still his first term, or I'm not sure. But then, because of the housing market bubble, they feared accelerating inflation. So they raised, they feared overheated economy. But actually, the economy, the real side of the economy, right? The real side of the economy didn't overheat. The financial market overheated anyway because of the housing market. Now, think about it. If the housing market overheated, what does that mean? There was a lot of lending for mortgage. In those days, people who couldn't qualify for mortgage, they still got the mortgage, and housing market boom. And then, people who had even derogatory credit, they got the mortgage loan, they bought the house, and then fearing because of that overheating housing market, which would again instigate the financial market crash. They feared that, so they raised interest rate to cool off the economy. But the real side of the economy didn't really overheat. It was only the financial market. It was only the financial side of the. And when the interest rate is jacked up, when interest rate was hiked up by 4.25% a year, the people who couldn't normally afford mortgage, their interest rate also, because they were on floating, they got the loan on floating interest rate. Usually when you get a loan, you get it at fixed rate. But these people were high risk people, so they their interest rate was floating, right? They got the loan at floating rate, or which means when the market rate goes up, their interest rate, right? So when the interest rate went up to 5.25, they couldn't. Their interest rate went up to like 10 point something, 11, 12 point something, and they couldn't pay the mortgage. So they lost their houses. They lost their homes. Their homes got foreclosed, and then there were too many homes, too many real properties that were suddenly on a resale market. This couldn't be. Normally, think about it. Somebody's borrowing comes from somebody's deposit, isn't it right? Somebody's borrowing comes from somebody's lending, isn't it right? So think about it. If you buy a house that is a $1 million house, if you buy a $1 million house with 100% loan, let's say that's not, but even in those days, in 2005, 2004, that was possible. I mean, at 1% down payment, with just 1% down payment, you can borrow like $1 million. So that means with just $10,000 down, right? 1% of 1 million is 10,000, right? So with just $10,000 down, you could borrow the other 99%, or $990,000, and you could buy a $1 million house. So think about it. Somebody's 1 million went to purchase that $1 million home. Make sense? And then when housing market crashed, what happened? There were so many properties suddenly foreclosed and put on the resale market. Now think about it. You have to recover that 1 million. Makes sense? You have to recover. The bank has to recover that 1 million because they owe 1 million to the lender.
The next person.
Huh?
Yeah, I was saying to the next person.
Yeah. So they had to, then the banks had to sell these $1 million property and recover 1 million. Then they have money to pay back their lender. But then think about it. If there's one or two houses, one or two properties in the market, in the resale market, foreclosed homes in the resale market, it doesn't affect the price. But suddenly normally there are 100 properties on resale market, right? Supply is 100, and the demand is also 100. Then price is in equilibrium. So there's it's not going to affect the price of these properties. But then suddenly there are 300 homes, 300 properties, 400 properties, 500 properties in the resale market, where while the demand is still constant, while the demand is still like 100. What's going to happen to the price of these properties that are suddenly put on the resale market? What's going to happen to the prices?
They're low.
Yeah, the price will nosedive, right? Because there's too much supply, too little demand, price will nosedive. So think about it. All these banks, they are holding like poison pill, right? They have to, if they sell, it's like a ticking time bomb. They have to recover $1 million from selling this house, and then they will have $1 million for their lender. But suddenly, when they sell, it's only 500,000. Price is 50% down, right?
Didn't they
sell,
sit together with other shares, like other?
Huh?
Didn't they mix it with other, I guess, mortgages with a higher rate, so it can look like it's a better package than it actually is.
Oh yeah, yeah. Actually, what happened was, all these, all these mortgages were resold. They were, all these mortgages were repackaged and resold, in the as a uh, mortgage-backed uh, mortgage-backed securities. But that's what really happened. But I'm talking about the mechanism. Why the market crashed? Why the housing market bubble bursted? And I'm talking about the mechanism. You have to understand the mechanism first. What instrument was used? That's the secondary thing. You have to understand the mechanism, right? So the mechanism is basically when there are too many properties, suddenly on the market, the prices fall. So the banks cannot recover 1 million; they only recover 50%, and then the lenders, they still owe the lenders 1 million. So what's going to happen to the banking industry? The banking industries will go into default when these loans become due. When these it becomes due to the lenders, then the bank cannot pay back 1 million. They can only pay back 500,000. The bank doesn't have money to pay. So banking industries collapse one after another, because this happened on a very large scale, right? So you understand the mechanism here, right? Why that happened. So basically the housing market crashed for that reason. And so to the economy cool down, right? Instantaneously in 2008, economy cooled off. Actually, housing market bursted in 2007, like September 2007. But the full-blown financial and that the ripple effect brought down the financial market. So the ripple effect, you know, finally, brought down the financial market in 2008. So the Federal Reserve had to lower the Fed funds rate down to 0.25, and that was held at that level until beginning of the 2016. And the trend since then, in between 2017 and 2018, over 2 years, it went up to like 2.25. The target went up to 2.25, and then back now after the pandemic. I mean, the economy was kind of doing well, and they were fearing overheating. Not really overheating, but they were talking about the tapering off, raising the interest rate back to normal, Fed funds rate back to normal. But then, this pandemic-induced, recession. There was shock, not recession, shock early on in 2020, and then during the pandemic, actually, the economy didn't really shrink that much, because they brought down the Fed funds rate back to 0 to 0.25. Okay, so that is the but Fed funds rate is short-term rate. In other words, Fed funds rate is basically a short-term, because in Fed funds market, the lending and borrowing is technically no longer than 1 year. I mean, they don't even lend for 1 year. They lend just about few days, maximum 30 days, 60 days. That's it's really so. Next, Fed funds rate again. So here's the mechanism. In other words, they're not. It's not a decree. It's not an edict. It's not like Federal Reserve is issuing an edict. It's not. It's not like let the Fed funds rate be 0.55% from tomorrow. It's not like that, right? And then suddenly, Fed funds rate is suddenly, 0.5. No, it's not like that. Why? First of all, we are living in a free market economy. What does that mean? In a free market economy basically, market economy means price is not dictated by an edict, right? Nobody says let the price of gas uh, be $3 from tomorrow. It's not like that. What determines the gas price? What determines the gas price? Anybody?
The demand and supply.
Yes, the demand and supply. And usually, also, of course, it's the supply. Supply is actually, supply holds the key, right? In gas. Why? Because uh, oil, petroleum is not produced by everybody. It's not. It cannot be supplied by anybody. There are only a handful of countries
Does
that
the
produce.
OPEC demand the price? Set the price?
Huh? What's
Does
that?
does OPEC set the price of what the
Yes,
U.S. market
yes.
will be?
OPEC sets the okay. The actual market rate is set by demand and supply, right? OPEC sets the target because OPEC is oil producing countries. Think about it. They if they want to uh, if they want to raise the price of oil, what do they do? What do they do?
They limit the supply that will be shipped
That's right. They limit the supply. And who is this? Who said that?
to the world.
Abo. Okay, so you got 0.25. Yeah, think about it. It's not like it's not like there is abundant supply. It's not like every country produces oil. It's only a handful of countries. So if it's a cartel, international. OPEC is an international cartel. So of course there are countries that are not part of OPEC. I think Venezuela is not part of OPEC. I uh, I don't think Norway. Norway is an oil producing country, but I don't think it is a part of OPEC. Uh, um, in North Sea, England, is it England or I mean UK or Ireland or Iceland in the North Sea. I mean Norway is also uh, drilling oil from North Sea. UK is drilling oil from North Sea as well, but they are not part of OPEC. US is all the US is probably the country with the largest oil reserve, oil deposit, basically shale oil, what they call shale oil. But US is not part of the OPEC. But OPEC is the major supplier of oil. It's an international cartel, so they kind of set their own price by limiting uh, the supply. If they limit the supply, the global demand for oil is relatively constant. Sometimes demand goes up because some country like China is basically siphoning off all the oil. When China was growing at a very fast rate, they were consuming a lot of oil. But also carbon, the polluter, the biggest polluter in the world, uh, as well. Now think about it. So OPEC is a cartel. So they basically set the price. But in Fed funds market, Federal Reserve is the main decider, main determinant of the Fed funds rate, but they are not dictating. They are not like, once again, in a market economy, you all know it's the demand and supply. It's the demand and supply, right? That sets the price. And OPEC is a distortion of the free market because OPEC is an international cartel. I mean, if it is a free market economy, if it is a market economy, they should let everyone. There should be no cartel, right? There should be no cartel. Every player, every actor, buyer or seller, must compete freely, right? But anyway, so there is no one central authority that in the free market economy, there is no central authority that sets the price, right? The price is determined by demand and supply, but at least they can set the target rate and they can work through the market mechanism. In other words, demand and supply, they increase the demand or they decrease the supply or whatever. They, through the market mechanism, they try to bring, the Federal Reserve tries to bring the spot rate, actual spot rate in the market, close to the target rate. That mechanism is, called open market operation. Open market operation. Okay. Now we have spent already, and a lot of them, 1 hour 30 minutes. So we're gonna talk about open market operation shortly, but let's see. So you all understand that if you have excellent credit score, you get the best interest rate when you borrow, right? Makes sense. And that best interest rate that the borrower with excellent credit rating gets is that rate is called prime rate. And prime rate is usually, this is not etched in stone, but this is, this has been, conventional practice, right? This has been conventional practice in the financial market, that the prime rate is something like 3% above the Fed funds rate. Prime rate is 3% above Fed funds rate. That's conventional. Okay, and actually, currently, Fed funds rate is just about 0.25 or close to 0. But then, what is the prime rate for long-term borrowing? Actually, I'm not flaunting. I'm not bragging. But my credit score is excellent. My credit score is top 1% of the population. I have like 845, 800, 830, 840 credit score. First of all, because I don't spend a lot of, but just because you don't spend money, it doesn't mean you can. The best way to raise your credit score is by getting a like a long-term loan like mortgage and making a consistent payment without if you miss for 30, if you have a 30-year mortgage and you have been paying like for the last 20 years and you have never missed any payment, you have always paid on time, or you have always paid constant amount, the exact amount, or you even paid some extra. I mean, there's nothing that beats this consistency in your record, right? If you have done this for at least like 10 years, 30-year mortgage, and if you have done, make this, they want to see your commitment. They want to see you're reliable. And if you're reliable, I mean, think about it. If you have never missed any payment, credit card or mortgage or car payment or whatever. And credit card is relatively less important. It's mainly like mortgage, long-term loan, like with 10 years to 30-year maturity. And then next is, car payment, because car payment usually, is between 3 to 5 years. Otherwise, business loan, if you have a business loan, that you have for 5 to 10 years maturity. And if you have made consistent, so you never missed anything, never missed any payment, everything is on time, that commitment will hike up your, credit rating, your credit score. So what kind of, interest rate, mortgage rate do I get, someone like me? I mean, when I first got the mortgage, I got something like 4 point something. Now it is, 2 point something, 2 point something. I'm not somewhere between 2 and 3%. So think about it. Prime rate is the rate at which the short-term rate may be, the mortgage is long-term rate. Short-term rate could be higher than that, but still, it's conventionally, it's Fed funds rate plus 3%, right? That's the prime rate. So then think about it. If I borrow at about 3% above Fed funds rate. Let's say that is 3.25 now, because Fed funds rate is. But when you, so what does that mean? I'm gonna have to use something, maybe, okay, here. So there is Mr. X who wants to borrow $1 million from Bank A. Come on. And he wants to borrow 1 million. Okay. And Mr. X has excellent credit score. He has credit score 830 credit score. So his rate will be, about 3.25%. If he borrows, it will be about at let's just say 3%, just to make it simple. He borrows 1 million at 3%. Now, where does this 1 million come from? Where does this 1 million come from? Obviously, that 1 million comes from someone, right? Let's call Mr. Y. Right? It must have come from Mr. Y. So it's obvious. We all know, then they will pay Mr. Y 0.1%, and they will lend it to Mr. X at 3%, so the bank makes 2.9%. But let's say Bank A, when Mr. X walked into the bank, Bank A was just flat out. They didn't have any additional 1 million to lend, right? They didn't have any additional 1 million to lend. But if they don't have additional 1 million to lend, what does Bank A do? Will they tell Mr. X to go away? Huh? Will they tell him, I'm sorry, we don't have money to lend, we don't have funds to lend, please go away, yeah. Please come back later? Will they do that? Huh?
No.
No, of course not. Because why? Mr. X is an excellent borrower, excellent customer with excellent credit score. So he is a high quality borrower. They don't want to miss out on the opportunity to earn 3% on the loan to him, right? It's a very safe 3% because he has excellent credit score. So then what do they do? What will they do? They don't have 1 million in excess funds, excess reserve. So what will they do? Come on, guys. What have we been talking about so far?
They will take another lend from a depository institution.
Yes, that's right. And who is this?
Mohammed.
Mohammed. Okay, Mohammed. So you'll get 0.25 for that, for answering that. Yes, we've been talking about the Fed funds market. So they will go to Fed funds market to look for another lending institution, another bank, to borrow 1 million from them, right? So suppose they borrowed 1 million from Bank B. So that's 1 million at Fed funds rate. They borrowed 1 million at Fed funds rate. And Fed funds rate is, let's say, Fed funds rate is 0.25%. Okay? As 0.25%. And where do you think this 1 million came from? I mean, Bank B, where did Bank B get their 1 million from? Where do you think Bank B got their 1 million from? Huh? Say it again?
From people putting in money in like savings bonds, CDs, things of the sort.
Yes. I mean, they're depositors, right? This 1 million is not any bank. Think about it. Bank's business is basically in lending other people's money. Banks make money by lending, using other people's money. So their deposit came from Mr. Y. And this is why, not Mr. Y, but this is why their 1 million came from Mr. Y. But what kind of interest do they pay to Mr. Y? What kind of interest
0.01.
do they pay? Huh?
0.01. So like literally
0.01, yes. Or 0.01 or just 0.1%, or basically what? Bank B cannot pay more than 0.25%. They cannot pay more than the Fed funds rate to Mr. Y. You understand? Because Bank B is making, how much is Bank B making from lending 1 million to Bank A?
0.25%.
Yeah, 0.25. They make simply the Fed funds rate. But Bank A is making, by lending 1 million to Mr. X, they make actually 2.75%.
2.75.
Bank A is making, right? They are making 2.75%. Why? Because they charge 3%, but they pay 0.25 to Bank B, right? So they make 2.75, and Bank B is making 0.25. So they cannot pay more than 0.1% to Mr. Y, regardless of Mr. Y's credit score. Let's say Mr. Y also has excellent credit score, like, his credit score is 840. Even if he has 840 credit score, that's why this explains why your lending rate is only 0.1. When you're lending to the bank, although when you are borrowing from the bank, your interest rate is like, when you're borrowing, it's like 3%, 5%, 8%, depending on 10%, depending on your credit score, and the spread is so wide. I mean, even if you have excellent credit score, when you are lending to the bank, you get only 0.1, because the bottom line they can make is from lending to another bank is 0.25%. So they don't pay more than, right? They cannot pay more than 0.25. They have to make something. And bank is making 0.15% from this deal, right? Because they lend to bank A at 0.25, but they have to pay 0.1%. So logically, this is the mechanism, right? This is the logical reasoning behind it. So you, no matter what, you go to the bank and shout out to them, hey, I put my $1 million in the bank and I get only 0.1, but when I borrow 1 million, why am I paying 5%? Right? No matter what, you call them out, and you challenge them in a dispute, in an argument. You don't have, they have their own rationale. Their rationale is, this is why. And if Bank B is, think about it, you might say, oh, Bank B can do better, but yes, Bank B can do better, but what if Bank B is a very safe, they don't want to take any risk, so they are, they want to place 100% safe bet. They will only, then the best thing is, they find own borrower with, like excellent credit score, or they lend to another bank, right? That's the reasoning behind it. It's 7:50, so I cannot. We don't have time for open market operation, the mechanism of open market operation, but I can talk about the role of the Federal Reserve. Federal Reserve is the central bank in the U.S. It's the ultimate authority in monetary policy. So it sets the target rate for Fed funds rate, and through the market mechanism, they will try to bring the actual Fed funds rate close to the target rate. And actual target rate is determined by supply and demand. That's called market rate and spot rate. And Federal Reserve is the regulatory authority in commercial banking. Okay, commercial banking. So retail banking, Federal Reserve is the regulator. But in the regulator for investment banking is SEC. Okay, for investment banking, the regulator is Security Exchange Commission. So if they do something wrong, something illicit, SEC can investigate and they can prosecute, or they can litigate, right? Any investment fraud and things like. So that is SEC, but commercial banking, it's Federal Reserve. Now, in the financial industry, there isn't only commercial banking or investment banking. There is also non-banking sector in financial market. For example, insurance companies. They are not lending organization. or they're not. Of course, they use the money. I mean, think about it. Insurance is a very, very big business. Why? If you have a car, how often do you use insurance? You must have car insurance, but how often do you use car insurance?
Almost never.
How often? Huh? Almost never. Why? Because you use car insurance only when you get into a serious accident. Isn't it right? Your car is totaled, or there was a major damage to your car. Obviously, for small, minor damages, like, fender bender, you don't use insurance. Why? Because you have to pay the deductible, and then to use insurance, you have to pay deductible, and if the cost of repair is not much.
Is larger than the deductible, then you don't get anything.
Yeah, if your cost of repair is not much bigger than deductible, because your deductible is, let's say, $1,000, and the cost of repair is 1,100. I mean, are you gonna, just for that 100 extra 100? Are you gonna use your insurance? Pay, anyway, whether you pay it out of your own pocket or use the insurance. I mean, the difference is insignificant. It's minor. It's just $100 difference. But if you use your insurance, then your insurance premium will go up, right? You don't want that. So, and also, so think about it. You pay, or probably your entire adult life, you will own a car your entire adult life. So if your life expectancy, if average life expectancy in the US is, let's say 85, probably since you're 20 and much earlier, if you live in the New York City, you can't have a car. First of all, you don't even have a parking space, right? But if you live in Long Island, if you live in Westchester, or if you live in Connecticut, if you live in New Jersey, not metropolitan New Jersey, I mean, like, not Bergen County, which is practically greater New York area, Bergen County, or Hudson County. But if you live in, like, Sussex County, New Jersey, Somerset County, New Jersey, wherever, Monmouth County, everywhere else, probably from as early as 16 or 18, you have a car. So if your average life expectancy is 85 in US, then your entire adult life, almost 65 years, for at least 65 years or 60 years, you will own a car. And all these years you pay insurance premium. Unless you have any accident, you don't use it. You don't get to use it. So insurance companies are actually cash cows that generate huge, cash flow for the insurance company. You hardly use. And what do they do with that money? They put it into the stock market. They put it into bonds. They put it into stocks. They put it into a whole wide range of portfolios. They maximize their return on investment. Make sense? But what about insurance industry? Who is the regulator? Remember why this was brought up? This was brought up because we talked about the regulator in commercial banking, which is Federal Reserve, the regulator for investment banking, that's SEC, right? Security Exchange Commission. But who is the regulator for non-banking financial industry? Oh, I already put it there.
CFPB.
CFPB, and what does that stand for? What is CFPB? What is CFPB? It's Consumer Financial Protection Bureau. Consumer Financial Protection Bureau. Okay? So suppose, your insurance company is insurance company is bilking you, nickeling and diming you for some escrow that you don't even need. You don't need this escrow account. They just set it up, on any kind of pretense, and they are bilking you. They are nickel and diming you, or your credit card company is, charging you some outrageous, interest rate, and you can take it to the you can report it to, you can file a report, you can file a complaint with the Consumer Financial Protection Bureau. Actually, I have, in the past, I have filed complaints with, Consumer Financial Protection Bureau because my bank was, charging me. They didn't refund some fee. They were charging fees, like for 3/4, 3/4 of a year, which wasn't a really big amount, but there was no reason for that fee. So, and then once I filed that complaint, it was otherwise, if you communicate with your bank, in writing, they don't even accept, they don't even take email. You have to write to them. They make it very hard to communicate with them because they make it very hard. They make it take a lot of time. They make the wheel of this process to turn very slowly. Everything has to be in writing, in mail. Jesus, it took. So I just reported it to Consumer Financial Protection Bureau. It was resolved within days. It was resolved really within, within a week. So that's it. Okay, we don't have we're running out of time. It's remember on last week I went like I told you guys, you owe me 20 minutes, right? I went so I'm going to call it a day here because anyway, there's no way I can go into as that open market operation today. So I'm going to talk about this tomorrow. And we got to wrap this up ASAP because I believe we already, what is that, topic 2? We are already into topic 2, right? The reading. Tomorrow, there will be more readings. I mean, more videos. Although we are reflecting on the past topic, you must finish watching the assigned videos for today, right? Within today. Okay? Alrighty, so that's it for today. Stop recording.